everybody. Good evening. Good evening to everybody here in the United States of America, and good morning to the other side of the world, specifically in the Philippines. I hope everyone is doing well. I'm just gonna hop in here and talk a little bit about the individual retirement account, which is very popular and everybody is asking about it. I mean, not everybody, but most people are curious and asking about it. It's the Roth IRA. Roth IRA is an individual retirement account that is available for everyone that is a resident or a citizen of the United States of America, as long as you have an earned income. You can have a Roth IRA at a very early age of 12, 13, 14, below 18. It's tied up to your parents' account. As long as you as a child will have what they call the earned income. You already have an income, you're working for whatever kind of work that you're doing. So I would like to dig a little bit about this type of individual retirement account, which is considered as one of the three, I would say three main tax advantage accounts considered as a retirement account for investment or individual retirement account. So let me share to you my screen. So when I try to educate myself, I usually go to this website, the very famous IRS, International Revenue Services, here for the people in the United States of America, and then website, because everything goes back to the government. They made the rules and they execute the rules, and we have to follow the rules and regulations or the law of the land. So IRS, and then I'm gonna type in Roth IRA. It's a lot of IRS and A, tongue twister. So let's open this. Okay. Let me go back here. So as I've said earlier, there are certain requirements for you or for someone to be able to contribute to their individual retirement account, particularly the Roth IRA. So let's see what we have. The limitations for the Roth IRA contributions is based on our modified AGI or modified adjusted gross income. So what does it mean? So it's your gross income for the whole year salary of all the work that you've made or you've done, you've executed. It's modified because it's already deducted. Some of if you have a tax deductible, they deduct that to your the real gross income. So they termed it as a modified adjusted gross income. So that's going to be another topic. And if you want to learn about it, you can always Google it here. It should be here. All right. So what are the contribution limits for the year 2021? Let's see if there is a change for the year from the last year 2020. So let's open the 2020 first. So over here, if you qualify, you have to be within this rule here. So if your filing status is married and you're filing jointly, both you and your husband, you file together, your modified adjusted gross income should not exceed 100, should be greater than 196,000. You can still contribute if you're less than 196,000. So if you're between 196 and $206,000 as a married filing jointly, then you cannot contribute for the Roth IRA. You go to the traditional or the simple individual retirement account. So then you can contribute up to the limit. So we'll talk about the limit in a while. If you're married filing separately, your adjusted modified AGI, adjusted gross income, should be lesser than $10,000. And if you live with your spouse at any time during the year, it should be equal to or not less, greater than or equal to $10,000. You cannot. If your income is greater than $10,000, you cannot contribute to this Roth IRA. All right. Going down here, if you're single and you're head of household, or you're married and you file separately, if your income is greater than or equal to $124,000, but not less than $139,000, you can contribute it with a reduced amount. However, if your income is greater than or equal to $139,000, then you cannot contribute. So let's wrap it up. Married filing jointly, you can contribute if you cannot contribute if you're greater than $206,000, and you can still contribute between $196,000 to $206,000, but a reduced amount. And if you have an income of less than $196,000, so then you can contribute for the full amount. And if you're married filing separately, if you're between $124,000 to $139,000, you can contribute for a reduced amount. But if you're greater than $139,000, you can contribute zero amount. If you're single, is there any single here? Oh yeah, we already talked about that earlier. Right here. Okay, so that is those are the what you call this, the requirement. So first is you have to have an earned income, and your earned income will be in this category here. Okay, so let's talk about the limit. How much can you contribute for the year 2020 and 2021? Okay, for the year 2021, 2020, 2021, 2019, I'm sorry, this is from the IRS website. So these are the real numbers. So you need to go find the correct information, go to the irs.gov and go to the section that talks about the retirement contributions or anything to do with your retirement. Okay, investment and retirement. So for both the traditional and the Roth IRA, you can contribute up to $6,000. And if you are $6,000 if you're less than 50-year-old, and if you're 50-year-old and above, you can contribute $1,000 more, which equals to $7,000 in 1 year. That is the limitation. Yeah, what else can you do here? So like say there's a thing here that says spousal IRA. So like for example, if one of your spouse or partner, or let's say spouse, because legally you're married when it's a spouse. When it's a partner, it's not. You're not legally married. So if one of your spouse is not working and you are working, you can still open a spousal IRA even if he doesn't have any earned income, and the limitations and the requirement is the same as if he or she is working. So if she or he is less than 50-year-old, then he can contribute $6,000 in a year. If he is 50 and above, he or she is 50-year-old and above, then he can contribute $1,000 more, which is $7,000. Okay, now we have to be really, really extra careful when we do our contribution in a year. You want to make sure that you're not gonna contribute excess meaning your contribution will not go over $6,000 or $7,000. Now, in the case that you've opened two Roth IRAs, just like what I had before, I always want to make sure that if I contribute to both of them, I'm not going to be over the limit of $6,000. So you just, however you want to do it. So that's it. So there are tax, penalties if you do this. So the best thing to do is before you file your taxes, you want to make sure that you will check on your accounts, if you have more than one account, that your contribution for that particular year will not be over the limit. So if ever you did over the limit, an excess IRA contribution, of course, if you did, like deposit or contributed over the limit, and you make a regular IRA contribution for 2019 or earlier to a traditional IRA at 70 and a half or older, you make an improper rollover contribution to an IRA, so you will have a tax liability on this. Excess contributions are taxed. If you contributed more than the limit, you will be taxed at 6% per year for each year the excess amount remains in the IRA. The tax can't be more than 6% of the combined value of all the IRAs of the end of each tax year. So you have to avoid the 6% tax on excess contributions. What should we do? You must withdraw the excess contributions from your IRA by the due date of your individual tax return. That's why I said earlier, before you file your tax, you want to make sure, you want to check your contributions. If you did go over the limit, then you want to make sure you will contribute the limit, the overage, or the more than what's the limit of $6,000 before you file your taxes, or otherwise you'll be penalized with 6%. You'll be taxed with 6% per year for each year you have the excess amounts in the IRA. So say you did $10,000 and you're only supposed to do $6,000, then you will be taxed 6% of that overage of $4,000. So 6% of $4,000. Okay, so I'm not a financial advisor. I'm just here to answer some questions that some of my friends and colleagues are asking me and curious about this topic. And I would advise to read just like what I'm doing, or the best thing to do, the best practice is to call your CPA, your certified public accountant, and talk to them about IRAs and tax contributions, etc. Or if you have a financial advisor, they would be the best person to answer your questions if you would like to go through that route. All right, so moving forward, I think that's it. Let me see if there's any other stuff that we need to know. So April 15 is the deadline for the tax, for us to file our taxes for our personal tax and business tax. And you want to make sure that if you want to fully fund your Roth IRA, you go ahead and you do it. And that way, you can contribute, because you can contribute up to April 15 of 2021 for the year 2020. Then after you fully fund that account, then you can start doing the 2021, which is also going to be up to the next year, 2022, by April 15, if they don't change the deadline for the tax filing. Okay, so what are the advantages of having to contribute or deposit your money towards your individual retirement account via Roth IRA? Roth IRA is a post-tax or an after-tax account. So meaning you are taxed right now at the present. Say you put $6,000 this year, you will be taxed $6,000 of your $6,000 will be deducted will be taken, taxes will be taken from your $6,000 depending on your tax bracket. However, your $6,000 will grow tax-free, and the time when you have to do a required minimum distribution, meaning at the age of 59 and a half, if until further notice they change the age, once you reach 59 and a half, then you won't need to worry about being taxed then, because your money grows tax-free and you withdraw it tax-free. So that's a very the best reason why people would opt to having a Roth IRA. Another good reason too is a Roth IRA. We know that it is a retirement account. It's supposed to be used during our retirement. However, if ever we needed some money, if there is emergency stuff that's going to happen to us in the present, we can actually use the capital that we put into this account. Like say, if you want to take money, you don't need to from your Roth IRA. Yes, you can do that. You don't need to wait until 59 and a half because you want to avoid tax penalties or tax liabilities. You can take money from your Roth IRA with no taxes before 59 and a half, as long as you're taking money from your principal. Say, for example, 2020, you put $6,000 and your $6,000 grow into, like, say, $8,000, and you want to use your $6,000. As long as you're within the $6,000 limit, you want to withdraw that money, you won't be taxed for that. But if you go over 6,000, then you will have tax penalty. So that's another really good reason why it's best to do a Roth IRA compared to the traditional IRA. So if you are qualified to do this, it would be really nice to make sure you contribute up to the limit. You fully fund your your Roth IRA. And let me show you this, why it's better to put your money in a retirement account or any investment account rather than in savings account. Your money will really grow, faster, or they work harder than any other. So I'll show you this Roth IRA calculator. So say, let me see. Okay, so say so like say, for example, if you started contributing, you went into the workforce at the age of 20, and say current age is 20, and then you contributed $6,000 for that first year that you worked, and you don't have any money, that's your first money there. So let's say the rate of return is between 7%. That's really like the lowest, but let's just say it's 10% if the market is really doing well. Let me see what we have. So you started at that age and you did not put any more money there. Let's see what it will give us. Let's calculate. It doesn't show up there. Let me try my wallet. Okay, so let's see this one here. It says asking if you're 20-year-old and your income, let's say 20-year-old, your income is $40,000 in a year. And what is your, like, say, you just started, so you don't have anything there. You're single. Okay, so wait a minute. And then you contributed every year starting 20-year-old, you contributed 6 thousand every year for your Roth IRA at the age of 67 with a 6% return, and if you're single, you will have $1 million when you retire. That's a lot of money, right? So that's the power of compound interest. That's why it's better if you invest your money instead of putting it in the savings account. Although it's in the savings account, it's guaranteed, it's there, it's not, you're not gonna lose it. But history of investment, it market goes up, goes down, market crashes, market collapses, but it always goes back to normal. As long as there is life on earth, the stock market will always gonna be there, no matter what, because everybody uses, everything that's in the stock market. There is a reason why they're there, and people are using it, people are consuming it. So that's all about individual retirement account. So I'm hoping you guys were able to get something out of it and learn a little bit tonight about Roth IRA. So if you have any questions, you can always type in down there in the chat, in the comment section, any questions or any topic that you would like me to research for you. I'm just here. So I've said I'm not a financial advisor. I just love doing this because I see the power of investment. I see the power of investing your money. We all work super hard. We wake up in the morning, we go to work and come back home in the evening, and we do all the household chores. It's like a never-ending grinding up and down. It's like hi ho, off to work we go, hi ho. But anyhow, that's life. So, but like in my case, I'm always a saver. I save my money as much as I can save, after all the expenses are being, paid off, all the bills are being paid off. I want to make sure there's always something that I can save. I always put my money in the savings account and it's not moving. So then I learned about investing and I tried this, slowly tried it, and I try to educate myself because it's always better to understand what you're doing before jumping into it. It's not like I would say it's to me, investing is for long. It's a long-term investment. I'm investing not for every day. I'm not a day trader. I'm doing this for my future and the future of my children and hopefully their children's children. So investing to me is a long process. It's not a sprint, it's a marathon. So that's why you need to understand what you're doing. Do not just buy anything that you don't understand. You want to make sure you do your diligence of researching, educating yourself, making sure, your hard-earned money from your daily job, you're not just wasting it and putting it into something in the stock market because somebody said buy this and buy that, but you don't even understand. Anyhow, life is good. God is good. We are here for each other. And I would say thank you for watching. I hope you got something from this video. And if you like it, you can like it. If you don't like it, you can also dislike it. Nobody's perfect. We're all here to learn from our mistakes, and we're all here to share our knowledge. So like and subscribe if you like the video. If not, that's okay. But thank you for watching, and I'm hoping for the best for you and your family and for the whole world. Bye.